G'day guys, Josh here. Welcome to another episode of Lacking Financial Education, and this is the big one with a lot of people who get their stumbling blocks taken out of, and well, not they hit a stumbling block, okay, just like I hit it just then, okay, and they get suckered into a get rich quick scheme, and they lose a lot of money because it was incredibly risky, or they get scammed altogether, and they come in asking like, okay, guys, what's an average rate of return that I should be looking at on an investment? What sort of average rate return is like appropriate for an investment that, I just want to get into where it's not, basically not trying to sell me 60% returns or anything like that per annum. What's the sort of return that I'm looking at in the long term, basically, as well? So basically, I could probably tell you guys all of this myself, but we should look at some of these financial advisors as well that use these risk profiles, like myself in my workplace as well, called investment risk profiles. And essentially, what it is, the method they use to do this is to pigeonhole you into whether you're a conservative or a growth investor, basically. So you can see here, there's a few graphs here as well that say here this says Australian property, this says Australian cash, and basically it tells you, the negative return in a year's 4%, very rare. The investment time frames over 3 to 5 years, and basically it's going to be 85-15% defensive. It also does tell you as well, like what its return to be is to be better than inflation. That's what its main goal is to beat inflation. Whether it's going to be 8% or 3%, that's pretty much it. Then you get slightly more riskier, and it tells you here it aims to be CPI plus 2 to 3%. So generally it aims to be 6%. And then down here it tells you it aims to be 7% over the long term per annum as an average. Of course, it's going to go up and down. And as you can see here, the probability of the negative year goes up. As you can see, 22. And you can see here, averages to be 4 or 5, and then negatives could be 25%. So you can see here already that basically it is likely that you could have a negative return, but overall, based on the long-term average from empirical data, that it goes up by CPI plus 5, which is about 8 to 10% for, your investments per annum. So that doesn't mean that it will always go up 8%. It'll just basically be like, one year goes up 24%, goes down 18, and stuff like that as well. Now, I may be saying this is incredibly very, very volatile, but these are the things that you've got to kind of understand as well, that this could be the case overall. And they have a few more investments as well with shares and growth and stuff like that as well. As you can see here, this is obviously Bridges Financial Services, part of ILLUSTRATIve. I'm just using their thing as a kind of a reference for you guys as well. As you guys can see there, is that the real rate of return that you're expecting per annum is probably more like 8%. So if anyone's offering you something beyond 8%, because obviously CPI is generally 3% from the RBA and 5% extra, if anyone's trying to offer you above 8% per annum, it means that their strategy is more likely to be riskier. Okay, so we go through in here as well. So basically, got leading advice. They're showing us probably a more better, area. The thing I was showing last time was I was just showing you basically what the rate of returns that you realistically would expect, which is basically 8% if you're doing shares. If you're doing full defensive, just hitting CPI, which is 3%. So like I say, it's between 3 to 8% per annum is the ones that you want to look at over 10 years. So you can see here, it's got your minimum investment period. It's got your forecast average returns over 10 years. So in this example for a defensive portfolio, which is 70-30, it's 5%. And it tells you like all the stats from the last 30 years, basically. Now, it does this also as well for the balanced portfolio. As you can see here, 5.7% return over the next 10 years. And minimum investment period for 3 years. Also, I want to really highlight this, okay? So be aware that that minimum investment period is that you got to invest your money for that long without touching it, okay? That you don't touch it, you don't draw on it or anything like that unless you're putting extra money in. And now you can see here the balanced growth investment, it gets higher, but also the minimum investment period gets higher because the probability of a negative return gets higher. So you can see here, 3.8 negative years out of 20, forecast returns 1 year, and you can see here how it really smooths out towards the end. That in 1 year you can get erratic returns, but as it goes on, you get more and more smoothed out returns. Now, last but not least, you can see here with growth, more erratic, 5 years, 7.2%. As you can see here, basically, they get more and more closer together. And last but not least, high growth, where it's 7 years, a long time. And you can see here, it's very erratic. I mean, negative 10 to 31, but over time, you get a similar amount as you did with growth as well. So basically, overall, all these portfolios will realistically return you about, from the maximum 12% per annum if you get, 7 good years in a row, and 4.2% if you get some so years and some good years as well, like two negative years. But you can see here overall is that anyone promising above 10% returns per annum or 10 to 20% returns per annum is kind of out there. Okay, so you got to be very, very careful about this. Like people saying you can triple your money in 2 days. You can just tell you right now that's an absolute load of bullshit. And you can use this video and use these risk profiles from actual financial advisors who aren't on TikTok and Twitter all day advertising how they can triple your money. Okay, that you can't do that. It's impossible to do that. You have to provide some sort of service to do that. And you have to generally you can probably do this in tech stocks when you're actually running your own business, but you can't do this by investing. It is very, very difficult. You have a lot of day traders out there, they think they can do this, but they never tell you about the losses, they only tell you about the gains. So investing is not sexy, it's a long-term approach. And looking at these risk profiles here, you can be like in your head being like, okay, so the best rate of return I can possibly get per annum is about 12%, okay? On, let's say you invest in all shares. But the worst I can get is about 4%, okay? And the average is about 8%. So if anyone's promised me above that average without some empirical data behind it, I've got to be very cautious of it because it could be a scam or it could be incredibly risky that, I could lose effectively all my money on it as well. Now, I'm going to go for one example. So one example in Australia, the NDIS scheme has been very, very frenzied at the moment because in Australia, you do not need to be a financial advisor to provide financial advice on property. And this is a term where property spruikers comes around because a lot of these financial advisors keep spruiking property to be the next big investment. And in fact, I know a few podcasters that always do this. They'd always be like, oh, property fell back, but it's a good time to buy. It will come back roaring back with 10% returns and stuff like that. And it's just like, mate, like, you're a property spruiker. You can't get into trouble for this because you know that property is not a financial product. Therefore, you making a recommendation is not enforceable by the Corporations Act. But let's talk about this for a moment. So NDIS Properties is basically a national disability insurance scheme. So effectively what happens is that basically if you make a property that's done for disabled people, so generally four people in a home and have one carer each. So what happens is that they will pay 85% of their disability pension to you as rent. You also get some money from the government for housing the disabled or having this property as well. But there's a lot of bureaucratic red tape involved to even get any of that. Okay, so first of all, you got to get property tenanted in a good, and also you're also all the risks of property as well, to making sure it's in a good area and stuff like that as well, because nobody's going to stay in a regional town where there's no faculties they can use if they're disabled. They rather have a shop near them and stuff like that as well. So location's all important. Now at the same time, they've marketed these yields at 10 to 20%, okay, and then sold as safe investments because the payments are made by the government while contributing to social welfare. Okay, so they tug on the heartstrings. They say it's backed by the government, which is false. It isn't. And also give you 10 to 20% returns, and also sold as safe investments, okay? That should give you alarm bells. Remember when we talked to you back here? So safe investments are generally cash and fixed interest. How much returns we were getting? 5%, okay? That should set alarm bells that someone's promising 2 times to 4 times that figure, okay? That is alarm bells, okay? Now, basically, a lot of this person also pointed out, which I agree with, such aggressively marketed investment opportunities some operators fear are grossly inflated, misleading, and will lead to a swath of vacant properties built in the wrong places and configured for a large population of high care tenants than it actually exists. In other words, it's basically oversupplying the market. And also as well, you got ASIC telling here, ASIC, which is our government periodic, is saying that the investors should be aware that these schemes are not government backed and should be on guard when offered unrealistically high returns, okay? And should be looked carefully with skepticism. Now, the reason why I'm going to tell you that is that it's offering 4 times the amount of the safe investment. It doesn't tell you most of the risks involved with this sort of investment. So I'll give you a bit of a lowdown with this investment as well. So to get these disabled pensions and these government-backed guarantees, including the rent as well, like these, these rents, which is about one of them quoted about 80 grand per annum. To even get that, it also said as well 55 grand after tax. To even get 80 grand per annum, you have to have a person that can run the clinic, and it has to be a qualified person by the law, by bureaucrats. It has to meet a certain standard, the property. If it doesn't, you don't get it. And most importantly, to get any of these benefits, it has to be tenanted by a disabled person. So if you have that house vacant for a year, you don't get that 20% return at all. Okay, you don't get any of that return because there's no one in the house and stuff like that as well. Not to mention as well is that the person who's operating it for you as a qualified NDS property operator, they want to get paid 10% of their costs. So they'll take the 10% of the costs out of you. They'll charge you for it because they're managing the property after all. And if they can't take it out of the rent, they'll come to you being like, hey, we're trying to manage the property for you and you're trying to maintain stuff like that. So can you pay us? And also at the same time, these property brokers are also taking their cut out of the property when you buy it and when you invest into it as well. So these 10 to 20% returns isn't actually a 10 to 20% return. It's actually probably a lot less after everyone takes their piece out of the pie. And also not to mention as well, like, it is incredibly, incredibly risky, which they don't tell you about. And this is why you got to look at it with extreme, extreme skepticism. And this is what the sales pitches of all these get-rich-quick schemes always have, is that high returns, low risk, and a chance to make a difference, okay? They tug on the heartstrings, they tug on your brain, being like, your greed, being like you can make lots of money. And that's what a lot of these get-rich-quick schemes do, okay? And they also, as well, you may think this is kind of familiar, okay? It is very familiar. You would have seen a lot of these brokers around promising you the world, okay? And saying that you have the chance to make a difference and stuff like that as well, okay? Now, overall, I'm going to tell you guys as well, you now know the expected rate of return, okay? We've gone through the investment portfolios. So expected rate of return is generally between 4 to 12%, okay? 4 to 12% for a high growth asset, okay? For the riskiest of riskiest, okay? So if someone's offering like, 10 or 11% returns for a risky asset, you'd be like, hey, that looks like it's in range, but let's do my research. If anyone offers you above that, red flag. Right away, you're going to take extreme caution on that investment. So I'm just going to say all of crypto is like that at the moment, okay? Extreme caution. Anyways, guys, let's just go through a quick summary before we end the video. So you can see here, forecast return 5%, 5.7, 6.7, 7.2, and 7.6. These are for all the investment groups, with 7.6 being the riskiest, and obviously 5% being the least riskiest. Now, of course, these returns compound over time, as you can see below as well, that they do compound heavily as well, with the highest end being 12.1%. But just be aware of the average rate of returns. Go back and check empirical data to see the average rate of returns before looking at an investment that returns higher than it. It's most likely that it's more riskier, more speculative, or they're just selling you a dream that's never actually going to come true. Anyways, guys, if you guys enjoyed the video, see you guys later, and hope you guys have a wonderful day. See you guys later. Peace out. Bye.